good news and to bad news, but I think it's looking more at the good news and the bad news, because there is good news and bad news. So on Bitcoin, we are climbing 26,770. If you look at the NASDAQ has just pumped to a 52-week high. Hasn't been this high for over 52 and weeks. To bad news, but I think it's looking more at, there we go, let me close that. You've also got the S&P 500 climbing. So clearly the market is fixated on the good news, which is the fact that a debt ceiling deal may have just been reached, and we're going to break that deal, or potentially we're going to break that deal live here on the show. But then there is also bad news. And the bad news is that we've got PCE numbers out, and those PCE numbers were, I mean, what's the word? What's the right word? Atrocious, terrible, completely unexpected. So now there is an interest rate hike probability. If you look at the probabilities of an interest rate hike, they've gone up to 52.8%. So just when we thought that inflation was under control and interest rates were going to start coming down, here we have it. Potentially in June, another interest rate increase. So there's a lot to cover here today. Is there actually a deal when it comes to the debt ceiling? That's the first thing that we've got to start talking about. Why is the market not responding to the PCE data? Why is the market not actually coming down based on the fact that the interest rates are going to increase? Has the market really been expecting this? And is this Bitcoin rally going to continue? So lots to do today. All right, I know there are a lot of people here who are wondering why we were so late today. We are trying to patch in one of the guests. One of the guests hasn't got good Wi-Fi. So we're trying to patch Harry Dent in. It is Friday today. It's our Banter Friday. We've got Harry Dent. We've got George Gammon. We've got Jim Bianco. We've got a big Friday banter here today. We're going to be talking about the debt ceiling. We're going to be talking about whether the markets are actually going to rally now. We're going to be talking about the PCE data and what this PCE data means, because it does seem like we're probably going to get more rate hikes. And what does that actually mean? So lots to talk about here today. And remember, guys, if you're new to the channel, subscribe. We're growing very fast, but we need you guys. Also, if you've been here for a long time, I see there's only 320 likes. Where are you guys? Where's the love? I know we were late, but we're doing it to get the guests onto the stream for you guys. And remember that our Friday banters are actually brought to you by our sponsor, NordVPN. Now, here's a good reason for you to support NordVPN. One is that they do mask your IP address and they allow you to surf anonymously. We've spoken a lot about what it means to surf anonymously, but also two, because there's Formula One this weekend. And if you want to watch the Formula One live on your laptops, you need to get a VPN. Then you need to go to the Formula One site where you can watch the thing live. And then you need to set your VPN on one of the countries that actually gives live broadcasts of the Monaco Grand Prix. So if you want to do that, the only way to do it is to get this NordVPN deal. I think you pay $3.17 a month. So, I mean, come on, if you're not going to protect your crypto for $3.17 a month and at the same time support one of our sponsors, what are you doing here? All right, let's get into the meat and potatoes of the show today, because there is a lot to discuss. Let us start off with the Bitcoin price. Let's look at the bubbles. Banter bubbles, all green. I wonder what this token is. Guys, what is GGTKN? Is it? It's a casino. Well, let's get some chat here in the banter bubbles. Also, I see this Maru token that we spoke about is also up. I see Arbitrum is up. We'll talk about that also later today. Hex still down. BitGet token still down. Sui recovering slightly. Today on the show, we're also going to give away the Tesla. We're going to give away the OKX Tesla. All right, let's talk about the PCE data. So big shock when it came to the PCE data. And remember that PCE is personal consumption expenditure. And that is the measure of inflation that the Fed use when they look at whether or not they're going to raise rates. They prefer this measure of inflation to CPI. So today, they were expecting a 3.9% PCE, and we got 4.4%. Now that's bad on two accounts. The first thing is we missed the forecast, and we missed the forecast quite aggressively. We missed the forecast by 0.5% or 0.5 bips. Also, though, we have PCE increasing for the first time in a long time. And what that's actually done is it's actually sent the probabilities of a 50 basis point rate hike to 52.8%. I'm going to just refresh this because I want to see, because this number has been moving very quickly today. So 55% now, 55% probability. Now, you will remember that I said to you guys very early in the game, I am expecting another interest rate increase. And more than that, I'm not expecting interest rates to go down this year. And I know the market is being quite optimistic. Let me quickly just show you guys. I know the market is being very optimistic. And if you look at the probabilities here, the market is kind of saying, look, we're still going to get one rate decrease this year and probably in November, and then not a second one anymore. Now, there were 3 like that. And so now the market's coming to the sober reality that rates are actually not going to decrease this year. And I've said that for a long time. I don't believe that the Fed's going to increase interest rates just to decrease them 2 months later. I don't think that that's how the Fed operates. And so now we're seeing it. Also, if you look at core PCE, not such a bad miss. Now, remember, core PCE takes out all the volatile elements in PCE. And so what you can see, the forecast there was 4.6%, and we hit 4.7%. But the market has chosen not to respond to any of this. The market's saying, look, we're not responding to this. We're responding to something completely different. What the market is possibly responding to is a deal or a potential deal or an alleged deal between the Democrats and the Republicans around the debt ceiling. Now, we first heard this deal here. So we first heard of this deal on Mario Norfol's Twitter Spaces. I'll play you the clip just so that you guys can hear it.
As of this morning, I have had conversations with 3 different people across both parties, one of whom is very close to the decision maker. And I've also confirmed now with one additional person who did also speak to somebody in on one side of the party. And it seems like the debt ceiling deal is now imminent. A handshake deal essentially occurred last night and early this morning. Now they're working specifically on final language. The debt ceiling deal is now imminent. It's a very big deal, and I can kind of share the sources, but I can't really share them.
So it was first broken on this Twitter Spaces. What we heard last night was we heard that they were very, very, very close to getting to a debt ceiling deal. They agreed in this debt ceiling deal to freeze spending for 2 years. So that was one of the things that they said. Remember, there was a big disconnect between the Democrats and the Republicans around spending. The Republicans wanted the Democrats to stop spending. And so there is apparently in this deal, which is allegedly approved and it hasn't yet been announced, the proposal is to freeze spending for 2 years. It says Biden and McCarthy near deal that would raise the debt ceiling for 2 years and cap spending on most items other than military and veterans. So that's where they seem to have sometime agreed or agreed in some shape or form. We will wait for official confirmation, but I guess that is the news that the market is responding to. And what is the market doing? Well, one, you're getting Bitcoin rallying off the 200-week moving average, which is very positive. We're back at 26,900, almost back in that $27,000 range. Remember, we want 28,000, 26,700. That's where we want to be to break above that head and shoulders. Then you've got the NASDAQ. Now look at the NASDAQ. The NASDAQ is now at highs that it hasn't seen since April 2022. That was the last time that the NASDAQ was at these levels. You got the S&P 500 also rallying, not to such highs, but we want to talk about the S&P 500 today because is this actually a real rally? I'm going to show you that potentially this thing is not a real rally. So that is what's happening today. It's a Friday banter. I've got, how many guests have I got here? 2 or 3?
Yeah, your audio is on.
Can you guys hear me?
Yeah, Ren, you're good now.
Amazing. Welcome, guys. Welcome. George, this is your first time on Banter. Welcome, my friend.
Yeah, thanks for having me.
We are trying to get Harry on, so we will get him on. He's always good value, great entertainment. Jim, welcome back, my friend.
Thank you for having me again.
Great, man. Let's start off talking about this, the PCE numbers. So the market's kind of chosen to ignore the PCE numbers and focus more on this potential debt ceiling deal that has maybe or maybe not been inked. What do you guys make of the PCE numbers and the fact that the inflation numbers are, I guess, higher, going up, increasing? Doesn't seem like a very positive, development.
I mean, my initial reaction to that is it's noise. And if I step back and take a 30,000-foot view, inflation, whether it's in the 1970s or the 1940s, it never goes up or down in a straight line. So I think you're going to have some volatility around this. Longer term, or at least looking out over the next probably 6 months or year or so, I would probably be in the disinflation camp. I don't know that they get down below 2%, but it depends. You know, if we have a black swan event, if you look at what the yield curve is predicting, we very well could go into deflation like we had in Q1 of 2009. It really depends on what type of recession we get. But then, you know, you have to look at what fiscal's doing. And if fiscal comes in with a response like they did in 2020, then you could see that next upswing with consumer price inflation. But I just think that from month to month, it's kind of, for me, it's just noise.
Okay, but if I look at the Fed tool, the one that shows us the probabilities of a potential interest rate hike in June, it looks like now the market's pivoted to saying that there is going to be another interest rate hike coming in June. Jim, what do you think? I know you've been talking about this interest rate hike quite a lot.
Yeah, there's been a big shift in this market. I mean, the probability of a rate hike in June back on May 4th, a little over 3 weeks ago, was 0. And now it's better than 50%. So the market is rapidly moving towards a June rate hike. And I think that that's exactly what we're going to wind up getting. I have a little different view than George. I am a little bit more worried about the inflation story. It's becoming sticky. You saw some bad numbers out of the UK. Europe's numbers have been struggling, especially in the Scandinavian countries. They're still pushing near 10% on core inflation. The numbers that you see on inflation, we're not going back to 9. I mean, just to be clear, but looks like we could stay in the 4% range, maybe even the low 5% range. Yes, in the next 60 days, we'll probably see a big dip down because of a base effect to the 3s, but we'll probably bounce back. And what I'm trying to say is none of this is going to get the Fed to do anything but raise rates. So when Jim Bullard came out at the beginning of the week and he says, I'm thinking about 2 more rate hikes this year, I think that is quickly becoming a consensus view. Whether it's right or wrong, I kind of have mixed feelings about whether or not the Fed should be raising rates anymore, that they might be doing more damage than good, but it doesn't matter what I think. It does look like the consensus within the Fed and with the market is starting to push towards a June rate hike and then maybe even another one after that.
Can we agree?
I think they're going to continue to break something, or they're going to continue to break things. And that's what's going to likely take you into a possible disinflationary wave or further disinflationary wave, maybe even deflation. If all things stay the same, I totally agree with Jim. Probably not going to go lower than maybe 4% or so. But if I look at like the near-term forward spread, it's predicting that the Fed's going to drop rates, and they're going to drop rates fast, you know, at the end of this year going into 2024. And if you think about the psychology behind Powell wanting to be Volcker and not wanting to be Arthur Burns, and then think about what it would take, what type of economic environment it would take for him to actually drop rates significantly very fast, to me, that's saying that there's a high probability of a type of, call it financial crisis, economic crisis, which would lead to very short-term disinflation and deflation.
You know, you summed it up well. What I said, I had mixed feelings about the Fed continuing to raise rates. That's my exact fear, is that will we be able to get away with it, in other words, or are we going to hike 2 more times and really break things? I mean, we've kind of around the edges with the banking system, but we can bust it wide open if we're not careful. And at some point, when I listen to speeches like from Fed Governor Chris Waller, he almost doesn't care what's happening with the banking system. I get that on one level, but on another level, the banking system will make him care when it blows up. And that's what he has to be very careful of.
Can we just agree that the market is being delusional if it's expecting rate declines this year? I mean, we're talking about 1 rate decline this year. I don't see the Fed increasing in June, potentially maybe increasing in July, and then reducing in November. Who believes that we may actually start declining rates this year or decreasing rates this year?
Well, it's delusional to the extent that there's the scenario that gets the Fed to do that, and that is that the economy crashes.
Yeah.
You know, that they raise rates, as George said, something breaks, economy crashes, and then they wheel around, they start cutting rates. Then the stock market shouldn't be going up 1% a day. If that's,
and that's what the curves are predicting. It's not me. You know, I'm just don't shoot the messenger.
What's your thesis? What's your thesis, George?
My thesis? Well, like I said, I just look at the yield curve, the 2s and 10s to keep it super simple. Or if you want to look at the Fed's curve, they look at the near-term forward spread. And that's predicting that the 3-month Treasury yield 18 months out will be significantly lower than it is today. So you have to ask yourself, and for those yields to be significantly lower, what needs to happen in the economy in order to make that happen? And that is a very, very hard landing, to say the least. So, we don't know what's on the economic horizon. We don't know what the catalyst will be, but the insiders are betting a lot of money that this is how it's going to play out. So, the yield curve has always been right, going back to 1950. So I assume that it's going to be right again. And when you look at when the curve uninverts, if that's a word, when it steepens out, let's say, when it's no longer inverted, there's a good way to do that and a bad way. And the bad way is when the 2-year goes back down below the 10. The good way is when the 10 goes back above the 2. And what we're seeing right now, what we've seen in the past, is the Fed drops rates, and that's what brings that 2-year down. And they do so because of some sort of crisis situation. And I think that's what my base case would be.
I would agree with that it really revolves around a crisis. And to say one thing about the market, something did interesting happen in early March, and I'm talking about the overall market. Now, we know in early March, that's when the banks started to fail. But basically, since that point, you could attribute the entire rally in the stock market to a handful of AI, ChatGPT, big cap tech stocks. NVIDIA being the big story yesterday. If you look at the average stock or the S&P 492 or 495 or the Russell 2000, which is down 6% since early March, while the S&P itself is up almost 6%. And that's a huge spread over 2.5 months for small cap stocks to underperform that badly. It does look like what the market is trying to say is, here's 8 big cap tech stocks. They don't care about banks. They're in the middle of a paradigm shift, and everybody's piling in, FOMOing into those stocks. Here's the rest of the entire market. Since the banks started to struggle, it hasn't done anything. And in this case of small cap stocks, have actually been going down. But we're too busy FOMOing into NVIDIA and Apple and Meta to actually notice that this has been going on behind the scenes.
I'm glad you brought that up. Harry, I see that you're with us. Welcome, my friend. I see we got you on your mobile phone. So at least we got you, though.
Yeah. Wasn't easy, but we got it.
It wasn't easy. No. If you want, Harry, you can raise the phone more so you're not looking down at the phone. It looks better, but it's all good. I mean, we can see you. Guys, I want to I saw this. Apple, Microsoft, and NVIDIA alone account for 60% of the year-to-date gains in the S&P 500. It basically is the three of those stocks which are having a very strong 2023 at the expense of I guess, the rest of the market. Everyone believes that there is, that the S&P is moving, but it's actually not moving. It's actually these three stocks which are carrying the S&P, and as Jim says, at the expense of all the other stocks, right?
Yeah, I just throw it in there too, that if there is one thing that is correlating very well with the bank stocks and with the rest of the market, is commercial real estate. If you look at Bloomberg, has an index of office REITs and has one of commercial REITs, and those are down 20-25% on the year. In fact, the office REITs made a new low for the year yesterday as we were all FOMOing into NVIDIA. And the bank stocks are tracking that too. And I think that what's behind this is, like it or hate it, I know we're talking on crypto Banter and stuff like that, and the whole idea of crypto is to get a new system. We don't have it yet. But the rest of the market does need financial services. It does need banks. It does need loans. And if commercial real estate and the bank walk that everybody's rushing into 5% money market funds is hurting the banks, it's going to be a problem for everything that is not an AI stock. And everything that is not an AI stock is really struggling right now. So it isn't just that those stocks are going up. It's also that everything else isn't doing much of anything. And in the case of small cap stocks, which are more reliant on banks than the larger stocks, because they still have the capital markets, they're struggling even more.
Hey, real quick, I see this all the Fed. Thank God they finally shot themselves in the foot here. They have been doing nothing but stimulating since 2009. Did not let that downturn reduce record debt levels globally, consumer debt, government debt, business debt, everything. They did not let us do the economy do what free markets do best. They boom, and then they take out the bad companies, the zombie companies, and the bad debts, and move on. So and then they've been stimulating ever since. Now here's where they really blew it, though, and in two steps here. They overreacted to COVID. Okay, there's 2 years where the economy slowed naturally due to a natural virus. Nothing wrong with the economy or Fed management, which to me is a bad word right there, which they shouldn't be doing. And so they overstimulated. Now they've been forced to go the other way and tighten. This has been the biggest raise in short-term rates we've had in decades in reaction to them overstimulating. And now they're kind of forced to have tightened. People don't realize it's a 12-month lag on this stuff. They've already tightened the most, and it's going to hit into mid next year. So I think the economy is going to weaken. I agree with what was said earlier. Basically, you look under the hood, it's like, wait a minute, we're going to have to go down harder than people think here. Well, that would be the natural response to an economy that's been way overstimulated for 14 years. This has never happened at this level, and especially during COVID, when really it was a natural virus that would get over itself. And now they're forced to reverse. I think that the economy is going to weaken stronger than people think in the next 6 months. And then they're going to be slow. They're going to pause first. I think the next move is a pause, and then maybe after that, and it's going to take a while. But I think that by the end of this year, they're going to force back into stimulating, loosening rates again, which is going to now look really stupid. To me, this is what needs to happen. The Federal Reserve should not be, if you believe in free markets, you let free markets do what they do. You don't say, oh, we can never have a recession because people will lose jobs and it's bad for the economy and bad for politicians. So this is what's happened here. They stopped. I predicted this 20 years, not a year. 2008 looked just like 1930, beginning depression, which also came after the greatest stock bubble in history, greatest debt bubble back then. Same thing
Harry,
again. What they did was push this, and now they're stuck. So I think that sooner or later this year we're going to go back down again because they've had to tighten. It's going to hit more months, and they can't just turn around and loosen. I think they've defeated themselves. Thank God.
Harry, whenever you talk, you're moving your phone and it's becoming like really dry. And if you could just maybe put the phone down or something, just makes it a lot easier. It's killing my eyes. I don't know about you guys.
I'm traveling, so I'm not in a normal circumstance.
Anyway, if you could just put the phone anyway, guys, what am I missing here? Why is the NASDAQ at 52-week highs? Like, what am I missing?
I think what we have to do is compartmentalize the financial economy with the real economy. Right? Because those are two completely separate things. And oddly enough, unfortunately, now there's almost an inverse relationship between the two of them where the financial economy or the financial market really should be a derivative of the real economy. But to dovetail on what Harry was saying, I've just got some statistics that I wrote down for a whiteboard video that I'm working on. We've got housing has gone down in most markets in real terms over the last year. You've got the problems with the commercial real estate. We've got the banking system. Before we went live, Jim and I were talking about the increased rates of theft. We know Target is reporting $1.3 billion loss or hit because of theft. Dollar General, I think it was, is saying the exact same thing. You've got the amount of people that can afford a $400 emergency payment. That's gone down actually for the first time. And by the way, that's not adjusted for inflation. You got the buy now, pay later loans, which 44% of Americans say that they're going to need to utilize in the next 6 months. And 21% of those say that they're going to have to use those to actually buy groceries. And I would like to remind everyone that this is with the unemployment rate at 3.5%. So we all know that Jerome Powell is trying to increase the unemployment rate. We talked about that just at the very beginning with him, with the PCE, and Jim thinks he's going to break things even further. If that unemployment rate goes up to 5% plus, let's go back and stress test, if you will, all those other metrics with a 5% plus unemployment rate. And I think that's what takes us right into likely a hard landing.
I think we're gonna need to.
I agree that is going to be the big issue here, is that the Fed is going to keep pushing, and as you see signs of stress in the economy, and George, I might also throw in, if you want to talk about fraud, I thought the numbers that were reported yesterday out of Massachusetts. The state of Massachusetts revised all of its initial unemployment claims, taking out 171,000 claims, or 14,300 a week for the last 3 months due to fraud. 171,000 cases of unemployment insurance fraud in 3 weeks just out of Massachusetts. And oh, by the way, Kentucky's now looking into something similar. And I think if, you could probably bet the other 48 states also have something like that, that all of a sudden the initial claims and the state unemployment insurance programs are not just becoming a big cesspool of fraud as opposed to an economic indicator anymore.
And Jim, it's the same thing as the non-farm payroll. I remember that. Was that a week ago or 2 weeks ago? I remember seeing a chart on Twitter that showed that non-farm payroll had exceeded expectations 13 months in a row, which was completely unprecedented. But then what they're doing is they're overstating it, and then they're revising the next month. So if you actually look at the revisions, unemployment looks a lot worse than all the headline, which is what the market trades on.
Yeah, you're right. That number has been, that's the longest streak ever that we've seen with it. But if you sum it all up, what you see with this economy is something that we haven't seen before, and it is going to be really what I was going to lead to is that the Fed only focuses, it seems like, on 2 metrics, right? Inflation and labor. They see too much inflation. They see 253,000 jobs being created. Yeah. They're probably going to look at the Massachusetts thing and say, oh, so the claims numbers are actually lower if you take out fraud, which means that the labor market is stronger. Oh, but everything else in the economy is falling apart. Raise rates because we have an inflation problem.
Yeah, it just goes back to the Phillips curve.
Yeah, that's exactly the way that they're going to look at it. So we could talk about retail sales, and we could talk about investment and capital expenditures. It doesn't matter. It doesn't matter. The only 2 things that matter for the Fed are the labor market, which is very strong, and the inflation numbers, which are sticky. And that's why we're at 59%.
Hold on.
The Fed is going to raise rates at the June meeting.
Hold on. What do you think about legacy, Jim? Because I think that plays into it as well, just from a human psychological standpoint, that if you're Jerome Powell, you do not want to be remembered as Arthur Burns.
Oh, yeah.
You want to be remembered as Paul Volcker. So, I hate to even go there, but I think that him just being a human being, he's going to err on the side of taking rates too high.
Not only that, but you've probably seen in the last week or so, Gallup puts out a yearly survey of the approval rating or the opinion that the American public has of the Federal Reserve. And it is now the lowest number on record. It's 33% approve, or 36%, approve of the Fed. Now, they only started the survey in the 80s under Greenspan.
I was going to say about Volcker.
Guys,
right.
Is the Fed
I think you're right. I think Paul is worried not only about his legacy, but he's also worried about the reputation of the institution. And Gallup just told him the reputation of the institution is not in a good place. Yeah. And Gallup did go on to say the number one driving reason that people don't think highly of the Fed right now is because we have inflation. Okay, keep raising rates then. We got to get rid of this inflation. And well, what about the economy? Hey, we're still creating jobs. Hike again. And that's kind of what the mentality is at the Fed.
But
you're right, George, until we break something so bad that they can't ignore it. We broke the banking system in March, but they found a way to ignore it, at least for now. But we'll see what's coming next.
Yeah, and I think that's where you get the deflation like we saw in Q1 or Q2 of 2009. Just that quick, whatever, I don't know what it was running at, maybe 4%, 5%, you just go bam, straight down to -2. And then you get that response from fiscal. And then that's, what takes you straight back to 2021. But it's exactly what we saw in the 70s, exactly what we saw in the 1940s.
Is the Fed maybe looking at guys?
Buddy,
is the Fed maybe looking at the wrong metrics?
I was just going to say about fiscal here.
Can you hear me, James?
When you look at the fiscal situation in the economy right now, look, we might have a debt deal. And what does a debt deal mean? It's going to mean a restraint on spending. I'm all for a restraint on spending. I don't have a problem with that in the long term. But in the short term, what that definitely means is that the GDP has a big G component to it, which is government. you're going to get a little less government, at least short term, because of this restraint on spending. And then, not to get too technical about it, once we get a debt ceiling agreement in place and they can lift the debt ceiling, there's going to be a flood of Treasury issuance coming in the month.
They're talking about $700 billion
maybe
in the
as much as $1 trillion worth of Treasury issuance. Now, there is an appetite for this, but what I guess I'll put it in non-technical terms. When you buy a Treasury bill, that money goes to the Treasury's general account at the Federal Reserve. That is the functional equivalent of removing money from the financial system. So we're going to take a banking system that is struggling with deposit outflows and has problems. And where do you get the money to pay for a Treasury bill? Out of reserves. We're going to suck a ton of reserves out of the banking system quickly. But then they'll come back because the government will then use that $1 trillion to pay government employees, to hand out benefits, to pay vendors for all their buildings. So it will all eventually to back into the economy. But the initial move will be to suck that money out. Yeah. So there is a concern that the back end of this, remember the last debt ceiling hike we had was mid-December 21. They raised $700 billion of treasuries in 6 weeks right after that.
That's what went to the TGA?
Yeah, that's what the TGA went from 40 billion to 750 billion in 6 weeks, from December 71 to late January of December of 21 to late January of 22, from 40 billion to 750. What also happened in that period was the all-time high in the stock market. That was a tremendous drain on financial assets out of the system, and it put stress on it. In 2011, 2013, we saw the same thing. The market rallied. The market rallied into the debt ceiling because they're not issuing new bonds. They're not pulling money out of the system. Right. They're running the TGA down to zero. They're shoving
slow down there.
into it.
Let's slow down there and talk about the debt ceiling. So there is potentially a deal. The deal involves less spending or spending freeze by the Democrats for the next 2 years. The deal is for 2 years. It probably came in the nick of time because if we look at where the Treasury's balance sheet was, or their bank account was, their bank account was pretty much nearing zero. Do you think the market was actually really scared of a debt default, or do you think the market knows it's just theatrics? I mean, did anybody really think that there would be a default by the US?
I think it's a lot like nuclear war from a standpoint of everyone knows the probability is very low, but if it does happen, it's so catastrophic that you've actually got a position for it.
Yeah, the expected return. I was going to say the only people that thought that there was not going to be a deal are basically policy types that live in Washington, D.C. I mean, everybody else was, I'm talking about the broader market. It never was showing really any concern that there wasn't going to be a deal. I know we look at the credit default swap chart, but at its height, it was maybe putting a 3% chance of the Fed, maybe a 4% chance, depending on which assumptions you use, that the Fed was going to actually delay a payment or go into technical default. The Treasury bill yield curve did spike, but that's exactly what George said. The problem there is that we've never had a Treasury bill that is not paid on maturity. And so a lot of money funds didn't know if I owned a June 1st bill and I didn't get my money. I didn't know what I was supposed to. I have to value my fund every night. And I have to put a value on that bill on the night of June 1st. I don't know what value I'm supposed to put on it. If I put the wrong value on it, I'm going to get sued out of business. Yeah, so right. just sell it and buy an August bill. And that's why just because I didn't want to deal with the uncertainty. Not that I was, because a lot of people that sold them, I've talked to them, they didn't think they were going to default. But as George says, it's like nuclear war. The small chance that they might delay for 1 day, and then I have to put a number on this, and then I have to spend 2 years in court defending it. I'll just sell it and buy an August bill and not have to deal with this. And that's what you basically saw happen there. So
Harry, what do you
sum
think?
it up, the market was never worried about it.
Harry, what do you think? Do you think the market was worried? Do you think the market should be worried?
Yeah, I think the number one thing I'm watching right now is the stock market. The stock market, people forget, the NASDAQ took a 38% first crash, okay? That told me the bubble was over. It takes something like that, 30 to 40%, okay? S&P 28%. Now it's bounce. It's starting to turn back over. If the stock market figures This is not going to happen. If the economy weakens enough for the stock market to go down and start to make new lows, then I think, despite Fed policy and all their over and under doing it, that consumers and businesses start to smell a recession, and then the economy slows down faster and it's hard to fix. My demographic long-term stuff said we're at the bottom of the demographic strength, that started in 2008, which is weak through 2023. So the fundamental economy is weak. We've been living off total stimulus. So if consumers and businesses lose faith in the stimulus, because the stock market starts crashing again, which again, I'm a chartist, man. I look at charts and try to pretend I don't know what it is to get the best view. It looks like we're about to move into a strong third wave, the middle wave down of a bigger stock crash. If that starts to play out, that will scare consumers and businesses. And then the Fed is kind of useless to say, okay, well, we're gonna loosen again faster. I think it's going to be too late, and they've been too late all along. So we'll see. This is the trickiest circumstance I've ever seen.
So I want to just show you this. So I've been looking at the global liquidity versus the S&P. So I actually looked at it against Bitcoin first, and I've seen a massive drop in global liquidity in the last couple of weeks. Bitcoin responded, but the S&P and the NASDAQ haven't responded. And so I'm kind of looking at this and going, is this just a delayed reaction between the markets, and the markets are going to respond to this drop in global liquidity? Because we know that the NASDAQ is pretty highly correlated with global liquidity. I'm not going to comment about the S&P, because the S&P, as we know, is running because of the three stocks that we spoke about and this AI narrative, which we'll talk about in a couple of seconds. But when I look at it just from a liquidity point of view, not a pretty picture. I mean, it makes sense that the markets would follow global liquidity, right?
Yeah, I'm not sure how they're quantifying global liquidity.
Go ahead, George.
I'm not sure how they're quantifying global liquidity, but one thing I'd say, just based on what Harry was just talking about, is a lot of people think in the marketplace that if the Fed drops rates, then that's somehow going to be stimulative for the stock market. And if you look at history, that's actually not true. If you go into a bear market, the majority of the stock decline in the S&P 500 is actually after the Fed drops rates, or while they're dropping rates. And once they get to zero, they come with fiscal. That's usually when the market goes up. But the Fed just dropping rates in and of itself usually means there's a lot further to go on the downside with the S&P 500.
Yeah, I'll just jump in real quick and just highlight that one of the worst times to own stocks is when the Fed starts cutting rates. I know everybody wants to pivot, because why is the Fed cutting rates? And I'm going to use some technical language here, because they're shitting their pants. That's why they're cutting rates. Yeah. And you don't want to own stocks when they're shitting their pants. Right. Now that I've said that, we're looking at them raising rates in June. So we're not imminently on a rate cut anytime. But if we get to the point of a rate cut, it's because everything's falling apart and they're trying to stop it. And that's why historically, I've never understood the pivot argument, because that's like the worst time you want to own stocks.
Exactly.
So you feel more comfortable with the Fed raising rates. You're like saying, if the Fed's comfortable to raise rates, the economy is healthy. And when the Fed drops, starts dropping rates, it's because there's trouble and they need to start dropping rates to stimulate the economy.
The best time to own stocks is when the Fed is on pause or on hold. I mean, because they're not doing anything either way. Historically, that would, except for the post-crisis period, when we were at zero. But before that, historically, that meant we were somewhere near a neutral rate, and then there was no need for them to do anything. That was probably the best time for them. But raising rates, again, it depends on why they're raising rates. This time they were raising rates because they were trying to battle inflation, and that's not a good time for the market either. And it wasn't for, the first 9 months of 2022.
Hold on. So I just want to go through this. You're all pretty bearish. I mean, you're all telling me that at the end of the year, something's going to happen. The Fed's about to break something. You all sound really bearish. In this kind of market, what does your asset allocation look like? What does your portfolio look like?
I'm probably going to agree with Harry. It's for me personally, and I can't give any financial advice, but for me personally, it's 10% gold, just because that's insurance, and pretty much 90% T-bills.
I'm a little bit different, but kind of the same idea is that, if you want to play the AI stocks, you could play the AI stocks as a separate play. You're buying. I happen to believe that in the next 25 years, there is going to be a paradigm shift because of what's happening with AI. But I also remember, I saw Dan Ives on Bloomberg TV this morning saying this reminds him of the late 90s with online retailing. Yeah, Dan was right, because online retailing over the next 25 years did redefine a lot of the economy. But the first move from the late 90s to 01 was Amazon lost 94% of its value. Pets.com went out of business. So the first move in all the online retailers from 99 to 2000 was you lost 90% of your money. You probably got fired or chased out of that position. Then Amazon stock, which literally went from $100 to $6 over 18 months, went from $6 to $3,300 as we basically redefined online retailing. My fear with AI is that might be the next move. Let's all pile into the AI stocks because in 20 years, it's going to redefine everything. Yes, and you just lost 90% of your money. And then you chased out of it, and then it 500Xs after that.
Can I challenge you? Can I challenge you? So I agree with you, and I was around when Amazon collapsed and went in 2000, 2001, and I saw this all happening in front of my eyes. In fact, I lost my first .com company there. But with AI, you can kind of argue that the results are tangible and they are now, and that the growth curve of AI is much quicker than the growth curve of internet, because at the time when the internet was created and we were trying to sell pets on pets.com, we didn't have all the tools that we had to accelerate the growth of something like this. Now, you could say that the reason that AI right now has stolen the limelight from things like crypto, for example, and why? Because it's not a technology that has the promise of things to come in a long time. It's actually a technology which Microsoft has plugged into Bing now, which Google has plugged into, well, Bard is plugged into Google right now, and it is actually starting to work right now and change people's lives right now. So this is the first, and I've been around for multiple of these revolutions, but this is the first one where we're actually seeing the product add tangible value today without having to potentially go through the growth curve that most other technologies had to go through. Now, I'm sure that AI is going to still grow, but I could argue that unlike Pets.com, which was an impossible concept at the time, unlike Amazon, which was a ridiculous concept at the time, this actually works and works today and is making people more efficient. We've saved heads in our business because we don't need copywriters anymore, because ChatGPT is doing it. My lawyer can't charge me as much as he wants to charge me because I just generate the framework of an agreement using ChatGPT and send it to him and say, listen, just fix this up, as opposed to charging me 100 hours for drafting a new agreement. So I agree with you that all technologies have a bubble and then they crash. But I don't know if we're going to get a repeat of what happened with Amazon and Google and all the other ones.
All right, so let me throw the question back at you. The other big difference that we see between the late 90s and now was the late 90s was a bunch of small cap startups that were recently IPO'd that were soaring, the B2B stocks, the online retailers back in the late 90s. This is now happening with trillion-dollar companies.
Yes.
So is AI really going to be a transformational technology driven by 6 companies, or do we have to basically say that it's going to get gutted out of the Googles, and it's going to get gutted out of the Amazons, and it's going to be dozens of new startups that they may not even exist today, that is going to drive this? Because if you tell me that Google is going to be the driver of AI, I think it's going to massively disappoint. I think it has to come out of them and have to be spread out among the entrepreneur class to let them drive this, not Google drive it.
So that's why I think that Microsoft did the deal with ChatGPT, because they realized they couldn't build it by themselves. I think that Google managed to build it by themselves, and only because they had the data set. So remember, for AI, you need the data set, because that's what trains the model. Now, if you look at who has the data today, the people that have the data today are Google and Microsoft, and maybe Amazon. But otherwise, the data.
What about Twitter?
And Twitter. But this is the landscape for AI. I don't think that a small company is going to be able to overtake these guys purely because they don't have the access to the data and the computing power that's required to get these AI models to actually work. And that's why I think that we're not seeing a whole lot of startups with a whole lot of crazy market caps. I think we're actually seeing a very different thing. We're seeing Google's market cap increasing by hundreds of billions of dollars and maybe trillions of dollars because of just what they've managed to do there. George, I see you've got a smile on your face. So I guess you disagree with me there.
No, I don't disagree. I just don't play in this sandbox personally, because to me, it's are you an angel investor or are you a value investor? And personally, I'm just a value investor. So the way I define that is I just try to buy $1 for 50 cents instead of trying to buy $1 for $3, hoping it goes to $5. So the reason I'm so heavy in cash or cash equivalents with T-bills is just because I think we're in a long-term commodity super cycle. And I think that everything that the global elite are doing right now is very bullish for commodities long-term. So, I'm not saying anyone's right or wrong. I'm just saying for me personally, I would rather sit back, wait for a potential recession if the yield curves are correct, wait for commodity prices to come down, and then just go ahead and buy coal. I would much rather own coal or oil or copper at a cheap price than I would some sort of high-flying AI company. But that's
Harry,
just me.
A lot of that
what do you
stuff
think?
is very cheap right now.
Harry, what do you think?
Yeah.
Yeah, real quick. This is extremely simple for me. There's only one investment that stands out in this time and stands out so far, it doesn't have to do anything else. This is a defensive play. Second major bubble in housing, clear as bell. Second major bubble in stocks globally, clear. The only thing that does well, and look back at 2008, including gold going down almost 40% at the worst in 2008. U.S. Treasuries, the longest term possible, 10 and 30 year. TLT, ETF, 20-year average. TMF, 3 times that. I think you can see the biggest return on that fund in 6 months of any investment almost in history. It is the haven. It's not gold. Gold is better than other things, commodities and stocks. But gold, I'm targeting down to about back to 1,000.
1,000.
So it'll go down, but not as much as other things. I'm saying stocks will be down 80% plus. So there is no place to hide. Look back at 2008. The one thing that went up, when everything went down, including gold in the final stages of that, which I think we're going to see in the next year and a half, final stages of this downturn, is the 30-year, 10 and 30-year Treasury bonds. That is the safe haven. They could literally, and I'm telling you, we're in a trading range, 99 and 110. Look at this chart, TLT. It breaks above that 110, which I think is the next move. It's got to hold 99 first. I've got a target of 186 on the safest bonds on earth. Imagine you're in TMF, 3x that. I'm just saying that is so attractive. And I'm not talking, this is not a long-term play. Well, I'll talk about AI and tech stocks and where to be once we've seen we have to get rid of this bubble first. We have to get back down to reality. And for that to happen, everything's got to go down. Commodities, oil, everything, stocks, and only the Treasury bonds do well in that scenario. So that's what I want to be for the next year and a half. 30-year Treasury bond.
Yeah, I think that depends on your time horizon too, because in short term, I agree with Harry. Over the long term, I think there could be some different factors in there. What I'd really like to hear from Jim and Harry, because they're the experts, is really their view of fiscal. Because I think so much of what we're talking about depends on fiscal response from the government. I don't think that the Fed put really exists anymore, quite honestly. And I would point back to March of 2020. I think they're rather impotent. But what they need to rely on is now the government put. So, you know, if what I mean, and again, what Harry's talking about, the bond market agrees with him. If you look, even the Fed agrees with him. If you look at the near-term forward spread. And so the question is, I don't think what happens in the next 6 months, but after that, what's the government's response to it? And if they come out with, let's say, a $10 trillion CARES Act 2.0, if they come out with UBI, as an example, that's a lot different than if they're kind of, if they can't do anything because they can't agree on some sort of policy. So I know Jim and Harry have probably given this a lot of thought, so I'd love to hear their view.
I don't think there's going to be any fiscal response. I think if you saw what happened last year with a 25% decline in the stock market, you couldn't get the Fed to even begin to think about a put. You couldn't get Congress to even think about intervention. If anything, they're mad that the stock market hasn't crashed to give them an impetus for a debt limit. So if you're going to get a slowdown in the economy, it is going to have to become spring of 2020 proportions before you're even going to begin to see them talk about any kind of fiscal response.
Yeah,
they're about to announce a deal on the debt limit that's going to cut fiscal spending.
Right,
So
but do you think if we had like a GFC as an example, Jim, do you think that they would come together and do a big fiscal, or do you think that they'd still be in gridlock? Because if they're in gridlock and they don't do anything, I think Harry's right on the money.
Keep in mind, remember that in the original GFC, they did gridlock. They first of all, they voted down the TARP bill, and the market blew up and forced them to vote it back into place. If we had a GFC, yes, they might come. But I guess what you're saying is, George, call me when we're down 35 or 40%. I mean, at 10% or 15% is not going to move the needle for them.
Yeah,
it's going to have to be epic before you'd even see any kind of Fed or fiscal response. So if the stock market trades back to the lows in October of around 3,700 or something like that, there's going to be no movement at all on a fiscal or Fed response on that. You trade under 3,000, okay, maybe then you've got it. I'm not saying we are. I'm just saying that it's got to be that big before you see any kind of movement.
Yeah, I agree. Harry, do you think that if your scenario plays out over the short term, that they'd come in with more of this fiscal that would create what we saw in 2021 with the consumer price inflation?
You know, I think, of course, they'll reverse to loosening again, and yes, they'll be talking about fiscal. I think they're just going to be too late. I think they have stretched this so far both ways that I think they're screwed. Finally, thank God, because they've just overdone it all the way, and now they put themselves in this corner. The next stop in the stock market, if we break the new lows, and it will not take long to get there by the end of this year, will be down 60%. That will now be a stock crash greater than 2007, 2008, which led to the biggest recession we've seen since the early 80s and the early 30s before that. I think that's what gets the consumers and businesses on alert, like I said before. And then what you want, okay, what's another so many trillion in fiscal or monetary stimulus when you've already done 10 trillion in the 2 years in COVID, coming 10 trillion, 50% of GDP, and we're falling into a recession again? That's when I think the consumers and businesses get it and say, wait a minute, there's something fundamentally wrong here. And guess what? There is. We've been living off stimulus for 14 years. That's insanity. That's never happened in history and probably will never happen after this. They call it a great experiment. It was. I think it's going to fail. So I think it's when the consumers and businesses say, uh-oh, they can't turn this around. Markets, and I think the stock market's going to be the signal because it's the leading indicator. And we start breaking the new lows, and then we keep going. And next thing, you know what the target is? Look at the charts. The COVID lows, that's down 60% in the NASDAQ and the S&P 500. That says to me, to everybody, we're in a serious downturn. Nobody's going to be out buying a house.
Where do you put Bitcoin in all of this? Do you put it as a risk asset, or do you put it as a gold store of value?
Exactly. That's the best point made right here. Bitcoin is, they're saying it's a safe haven like gold. Even gold wasn't a safe haven in 2008. Bitcoin is the risk asset. It's like the dot-coms came in the late 90s, accentuated that bubble. Amazon went down 95%, folks. The leading new retailer, in the world, and has been one of the greatest stocks since. That's what happens here. Bitcoin has led this crash and will lead it for Bitcoin is minimum 10 to 11. I think, and I have to disagree with my crypto friends down here in Puerto Rico, I think it's going to 3,000.
Wow.
And that's going to, boy. And people are going to say, oh, it was a hoax. That's when I'm going to be buying Bitcoin, because Bitcoin is the next big thing. Digitization of all financial assets. That's a huge thing, but it's in its baby stage. And just like the dot-coms got overvalued in their early stage, so did the crypto here. The crypto is the bubble of bubbles. So anybody that thinks Bitcoin's a safe haven is going to be the most disappointed.
Yeah, I think if you look at 2020 March, gold and Bitcoin both went down. So then they rebounded, and exact same thing like Harry's saying with gold after Lehman. Jim, you probably remember how much gold went down. I don't recall the exact numbers, but I know it crashed after Lehman. when you would think that gold would be skyrocketing. And then what happened is toward the end of 2008, 2009, if my memory serves me right, once they kind of quote unquote fixed the problem, that's when gold really ripped higher. And we saw the exact same thing in 2020. So I would expect to see the exact same thing at the end of 2023 or into 2024.
I just throw in, you're right. I throw in that, Rand, Bitcoin trades like a risk asset right now, and that is its problem. It needs to become something other than a risk asset.
Yep.
As Harry said, it might, maybe with ordinals and Taproot, it's got the potential to basically build some kind of DeFi structure around it, that it could present itself as an alternate financial system. It's not there yet. So all it is a big speculative. It's not there, but it will. I think it will get there. But right now it is just a speculative tool, and that is the problem with Bitcoin right now. That is the problem with all crypto right now, is that fortunately what I see is the builders and the devs are still building and developing, and hopefully they will continue to build out the structure of a truly decentralized system, so that we could stop talking about regulation. And the reason I say that is that once you go truly decentralized, Gensler could say whatever he wants. You can't stop it because it's decentralized. And the other thing I worry about a lot with it, just a little off topic, is we're going to chase all of the devs and we're going to chase all of the development outside the United States. And then they're going to develop the entire new financial system without us.
It's happening. It's happening already.
I know, and we will lose in so many ways on that, because we won't even have a seat at the table when the new financial system is being developed, and they will turn to Russia and China for their advice and not us, and that will be catastrophic if we continuing to let that happen. I know that's what I'm saying. That's what really worries me. That worries me a lot. That is a gigantic mistake that we're making right now.
Seems like a repeat of the 1950s with the Eurodollar system.
Yeah.
I think on that note, that's it for this Friday's Banter. Guys, thank you so much. Much love from the Banter fam. Sorry about the connectivity issues in the beginning, but we did make it, and we did have a great alpha-filled show. We'll see you all again very, very soon. Thank you. And to the Banter fam, we are going to give away the Tesla now. So don't go anywhere. We're going to give away the Tesla now. Guys, thank you so much. We'll see you guys again soon. To the fam, okay, it's time. We're going to give away the Tesla. Let's quickly get the screen up with the winners of the Tesla. Now, here's how it works. I'm going to put up a screen, and I'm going to show you the user ID numbers of OKX. And the first user ID number that can verify that comes from the same email that you use for your OKX address. If you don't send the email from the same address that is linked to your account, it does not count. You will get to win the Tesla. So I'm going to show the number in 5, 4, 3, 2. Ready? Those are the numbers. So those are the user IDs. If your user ID is one of these user IDs, you've got to email giveaways@cryptobanter.com to claim your Tesla. You have to email us from the same account that is linked to this user ID. And you can see that you all had 31 raffle entries. That means that you had 31 trades in the raffle that actually counted. Those are the user ID numbers. First user ID to email giveaways@cryptobanter.com from the address will win the Tesla. So we are actually giving away the Tesla. Finally, you guys asked. Here are the numbers. Wow, can't believe I'm giving away a Tesla. And there's another Tesla to be given away from our Bybit competition. You've still got 4 days to play. Our man David is still in number 1 place, but he is being chased by this number 2 guy. We don't know who the number 2 guy is. Who's going to take away the second Tesla? Who's going to take away this Tesla? Wow, can't believe we're giving away a Tesla. It's huge. Also remember, just to give some love to our sponsor, NordVPN. I wanted to show you something very, very cool. So if you want to watch Formula 1 this weekend, there's a Monaco Grand Prix. I don't know if you guys are as obsessed with Formula 1 as I am, but if you want to watch Formula 1 this weekend, you click on this link and it shows you that the only place that you can get free streams is actually from Austria or from Belgium. Okay, so that's how I watch it whenever I go away. And so what I do is I download the VPN, I set my location on Austria or Belgium, and then I watch because it's free to Austrian and Belgian citizens. I do this using a VPN. So you can do that, just pay $3.17. At the same time, you protect your IP address, you surf anonymously. And as I've said to you guys before, you think you're playing indexes, you're safe. You're not safe unless you mask your IP address, because then the government can actually subpoena the front ends of these websites. Anything else happening today? Let's look quickly at the research group. Is there anything else that is going on today? I like to bring you up to the minute coverage. Not much going on. There is this potential deal. We'll let you know if the deal is finalized. Otherwise, I'll see you guys again on Monday. Until then, trade well, my friends.